This is part 6 of our Chapter 3 video lecture series. This should be the last video for Chapter 3. We had left off in part 5 talking about the accounting cycle, but I want to review that again using this diagram. So if you remember, back in Chapter 1 and 2, we were recording business events called transactions. And then in chapter 2 and 3, we were recording those transactions here in a document called a general journal. So let me show you an example of a general journal. So a general journal, this is like the business diary recording business events. We would write in the name, write in the date of the transaction, the accounts that are changing, and increasing them with debits or credits here in the dollar column, making sure at least 2 accounts are changing, and the total debits for one transaction equal to total credit dollars in the same transaction. Then we will move on to the next transaction and the next transaction. Again, journalizing business transactions here in our general journal. At a certain point, when we accumulate enough transactions here in the general journal, we want to transfer them, or the correct term is called post the transactions into the general ledger accounts. And the way we had illustrated temporarily those general ledger accounts was the use of T's. Remember, the left was called debit and the right is called credit. Well, we post them to each respective ledger account like cash, like accounts receivable, like rent revenue. One ledger account for each account of our company. And then we're going to get a balance of leftover amounts in these ledger accounts. And we're going to transfer them, or some professionals call it, we're going to pool a so-called trial balance. That's the document with 2 columns, one for debit balances and one for credit balances. And because this trial balance has balances that are not updated or adjusted yet, we call this trial balance an unadjusted trial balance. Just making sure that the total debit balances here in the general ledger are equal to the total credit balances, just to see what right now how much we have in each account at the end of the period, or at any time during the period. You can always pull a trial balance. But now at the end of the period, we want to have accurate and updated balance amounts. So we're going to go through our accounts and then update them. And the only way to change a balance in any of these accounts here is to journalize the change. And at the end of the period, those updates are called adjusting journal entries or adjustments. Just like transactions, we journalize them. Again, let me show you the journal here in the general journal. Yeah, and typically at the end of the period, December 31st, or whatever period you're looking at. Okay, where am I? Here on my illustration. Okay, so we're journalizing those adjustments and we post them to the ledger, just like transactions, updating the balances in our ledger accounts. And we're going to pull another trial balance, but this time it's called adjusted trial balance because it includes those adjusted journal entries. To help us figure out these adjustments, we had learned in the previous video there's something called a worksheet. So let me point that out again. This spreadsheet. So here's that unadjusted trial balance. Okay, we pull those balances to making sure total debit balances are equal to total credit balances in the general ledger. And here's where we want to end up with these balances after adjustments. So in between the 2 trial balances is our adjustments. And to help, again, figure out what the amount of those adjustments should be, we kind of lay everything out on this worksheet for every F debit here, we have to have a F credit. So we're matching up the debits and credits. Yeah. Um, B debit, here's B credit. Okay, so this is a worksheet. I'm not going to have you do one, but again, accountants use this type of tool, a spreadsheet, a lot. So let's go back to our adjusted trial balance here. Now, with this adjusted trial balance, you can prepare those financial statements we saw in past chapters, like the income statement, the statement of retained earnings, the balance sheet, the cash flow statement. Okay, so we got those financial statements, and now we're ready to start for the next period, next month, next year. But before we do that, we want to start off with zero revenue, expenses, and dividends so we don't mix it up with last month's revenue, expenses, and dividends. We also want to update the retained earnings account. And the way we do that, updating these balances here, is to journalize some more. But this time, we learned in the previous video, those were called closing journal entries. And there were four of them. Number one, to close out revenue. Number two, to close out expenses. Both closed out into a temporary account called income summary. Closing entry number three was to close out income summary also itself. And then number four was to close out dividends. Okay, so you journalize all those four and you post them to its respective general ledger accounts. So now whatever revenue, expenses, dividends you have here all have zero balances. The retained earnings ledger account should be updated for the profit or for the loss and the dividends you had paid in this past period. But because you have new balances here in the general ledger, what we're going to do is pull one more trial balance, this time called post closing trial balance, because we've already journalized and posted the closing entries. So when you look at this post-closing trial balance, revenues should be zero, expenses should be zero balances, dividends zero, retained earnings updated for the past period. Now we're ready to start the next period's transactions, journalizing them, posting them to the ledger. Yeah, and at the end of the next period, journalizing adjustments and posting to the ledger, preparing another trial balance, preparing the next period's financial statements. Yeah, and then again doing everything over again. This is why we call it a cycle, the accounting cycle. Let's move on to the next couple topics here in our chapter 3, the last two topics. The next one is to prepare a balance sheet again, but this time it's called a classified balance sheet. So let's take a look at an example here. So we still have assets on the left side and liabilities and equity on the right side, just like the accounting equation we saw back in chapter 1. But when you look at the assets, they're now grouped or bunched into smaller categories. This one called current assets. So I'll let you read in the textbook a definition of each of these sections, but briefly, current assets are assets that are cash, are going to be converted to cash or used up relatively quickly. When we say quickly, we really are meaning something called an operating cycle that could last 1 or 2 or maybe 3 months or a whole year. Typically, we look at whatever is longer. In most cases, a year is longer. So in other words, anything that can be converted into cash right now or receivable as a cash, like accounts receivable, or sold within a year, or used up within a year, those type of accounts are classified as current, and we take a subtotal. The next category is called investments, typically securities or some type of investment in another company or even a financial institution deposit account that you're not going to use within a year. If you are going to be cashing it in with a year, then you would move that investment up here in the current section. We see also now this plant and equipment assets discussed here in chapter 3, including land. And also here, the new account called accumulated depreciation. That's a contra asset recorded with a credit versus an asset account like equipment recorded with a debit. When we combine the two, debit and credit, again, we take the difference. And here, this difference of 150,200 is called the book value of the equipment, the leftover cost that we're going to be using up in future periods. And then intangible assets, things we cannot physically touch, like a business license or maybe a leasehold interest. We'll talk about more about plant assets and intangible assets in a future chapter this semester. We take a grand total of all the sub asset sections. And now on the right side of the balance sheet, we have in the liability sections kind of a mirror image of the asset side. We have current liabilities, liabilities that are going to be paid off within an operating cycle or most times the longer period, 1 year. And we got to make sure we have enough funds here to pay off our current liabilities. So you kind of look at your cash and receivables here, maybe the inventory you're going to sell to convert to cash. Do you have enough of this here to help you pay off your bills that are going to be coming due soon? Liabilities that are going to be paid off beyond a year's time are classified as long term. And if any of this long term is going to be due soon within a year, you would move it up here into the current section. You add up the current and the long term to get a grand total for liabilities. And then in the equity section, we've seen the common stock account balance. Now the retained earnings has been updated, you remember, with the closing entries to get a grand total for equity. Adding up total liabilities plus total equity, this grand total here, again, we know in the accounting equation that has to equal our total assets. Okay, let's take a look at the analysis now section. Trying to calculate something called a profit margin and current ratio. So a profit margin is a statistic to determine, of course, the profitability of a company. And here you can see we have a couple companies' profit margins for Visa and MasterCard. They're in the same credit card industry. And you can see how this is pretty big, 53% and 48%. Bigger the better. Also, you can see the trend here compared to previous years. Are they getting better or worse? Again, higher the better. Bigger the better between companies. You know? So the calculation for profit margin is to take the net sales for your year. We'll define what net means for sales in the next chapter. Basically, this is the revenue. And we divide that into the company's profits. This is the bottom line of the income statement. This is kind of at the top line of the income statement. And the way to kind of read this is for every $1 of sales, how much net income do you have? You know, here, for every $1 of sales for Visa, they get 53 cents. Again, this is quite large. So I just looked at the profit margin for a bigger company, Amazon. And here you can see they're dealing with 12 billion, yeah, 23 billion. Amazon is dealing with hundreds of billions per year in their sales figure, yeah. Their profit margin is real small, something like 2 or 3%. Yeah, but I guess they make it up in bigger sales, bigger profit. Yeah, but again, relative wise, if you compare the profitability, the profit margin, that type of industry, especially retail, is relatively small compared to a financial company like Visa and MasterCard. Let's take a look at our last ratio here called current ratio. This time for big retailers, yeah? And the formula is to take the current assets that we just learned about in a classified balance sheet and divide it by the current liabilities. Again, assets going to be used up within a year, converted to cash within a year, and liabilities becoming due within a year. Um, Sometimes a big ratio is not good. A small ratio is also not good. So you got to find that good zone. And in case for a big companies like Costco and Walmart, this is probably good for them. A 1.01 current asset to current liability ratio. Yeah, here. To me, this is a little small, but looks like it's working for Walmart. The main thing, the way to interpret this is um, in the case of Costco, they have $1, 1 cent of current assets to help them pay off $1 of current liabilities. In the case of Walmart, they have 80 cents of current assets to pay off $1 of current liabilities. So for most big companies like this, where cash is continually coming in every day, probably a ratio close to 1 is okay. $1 of current assets to $1 of current liabilities. But for most other companies, smaller companies, where cash coming in will kind of fluctuate, probably you want a higher current ratio, something like $1.50 of current assets for every $1 of current liabilities. Again, it depends, but you don't want to have it too big. That means you have too much current assets. You don't want to have it too small because that means you may not be able to have enough funds to pay off your current liabilities that are going to be coming due soon. Okay, let's stop here. Again, make sure you work on your homework assignments, your Learn Smart assignment, and before you take the quiz, you gotta study. You gotta read the textbook. Okay, I'll talk to you later.